Hey friends, welcome to Money RX for CRNAs and nurse practitioners. I'm Brett Fellows, certified financial planner, and today we are talking about two tax strategies that can save high-earning nurses hundreds of thousands of dollars over their entire careers. The Backdoor Roth IRA and the Mega Backdoor Roth. Now, if you're a CRNA or a nurse practitioner earning over $168,000 a year as a single filer, or $252,000 a year if you are part of a married couple, well, you cannot contribute directly to a Roth IRA. Why? Because those income limits actually kick you out. But there are ways around those limits, and these are legal ways, IRS-approved ways. And so today, I'm going to walk you through exactly how they work. And I want to start by giving you a hypothetical. So imagine a CRNA. She is 35 years old and she's making $210,000 per year. She's been maxing out her 403(b) contributions every year and she is doing great. But when she tries to open up a Roth IRA, well, she finds out that she's not eligible because, of course, her income is too high. This is actually a situation that I see constantly. Nurses earn excellent incomes, yet they are locked out from one of the best retirement accounts available. And here's why that matters. Roth accounts give you tax-free growth. Roth accounts give you tax-free withdrawals in retirement. Roth accounts have no required minimum distributions when you turn age 73 or 75. So your money grows and you never pay taxes on it again. Now, for a CRNA who might have 30 or 40 years until retirement, well, that tax-free growth is massive. So what do you do when you are locked out because of your income limit? Well, you use a backdoor. So let's look at how. What exactly is a backdoor Roth IRA? A backdoor Roth IRA is just a two-step process. Step number one, you contribute to a traditional IRA. You use after-tax dollars and you do not take a deduction. Then step two, you immediately convert that traditional IRA to a Roth IRA. And that's it. Money goes in the front door of a traditional IRA, and then it goes out the back door into a Roth IRA. And the IRS has no problem with this. It has been legal since 2010. We have high-earning nurses using this strategy every single year. For 2026, the contribution limit is $7,500 if you are under age 50, or $8,600 if you are age 50 or older. Now, I get it. It's not a huge amount, but it adds up. Let me give you some math. If our 35-year-old CRNA does a backdoor Roth every year for the next 30 years, contributing $7,500 per year annually, and let's say that money grows at 7%, well, she'll have about $709,000 in her Roth IRA at age 65, all of which is tax-free. Now compare that to putting the same money into a taxable brokerage account. Well, after taxes, she'd have about $539,000. So that's $170,000 less. So for most nurses, the backdoor Roth IRA makes sense. But there is a problem that trips people up, and it's called the Pro-Rata rule. This is the biggest mistake I see. The Pro-Rata rule says that if you have any pre-tax money already sitting in a traditional IRA, a SEP IRA, or a simple IRA, well, the IRS will treat all of your IRAs as one combined account. So when you do a backdoor Roth conversion, you are taxed proportionately. Let me give you an example so you get a better understanding. Let's say you have an old rollover IRA from a previous job and it has $93,000 in it, all of which is pre-tax. Then you open a new traditional IRA and you contribute $7,500 of after-tax money because you plan to convert it to a Roth. Well, your total IRA balance is now $100,500. And only 7.5% of that total is tax-free. So when you convert that $7,500 to the Roth, the IRS says, guess what? 92.5% of it is actually taxable. So you owe taxes on $6,937. And that frankly defeats the whole purpose. So how do you avoid this? Well, you roll over your pre-tax IRAs into your 401k or 403b before you do the backdoor Roth. And most 401k or 403b plans accept rollovers. Once your IRA balances are zero at the end of the year, you can now do a clean backdoor Roth conversion. And this is critical. If you do not handle this pro-rata rule correctly, you will end up with a surprise tax bill. So how do you actually do a backdoor Roth IRA? Here's the exact process. Step one, again, make sure you have no pre-tax IRA balances. Roll them over to your 401k or 403b if needed. And step two, open a traditional IRA and a Roth IRA. Now, companies like Vanguard, Fidelity, Charles Schwab, any major brokerage will work fine. Step three, contribute to your traditional IRA. Again, $7,500 for 2026 or $8,600 if you are age 50 or older. Step number four, this is important. Leave the money in cash. You do not want to invest it yet. Step number five, convert the traditional IRA to your Roth IRA. Ideally, you would like to do this within a few days' time. Step number six, now you can invest the money inside of your Roth IRA. And finally, step number seven, you want to file Form IRS 8606 with your tax return. This form tracks your non-deductible contribution. And that is the entire process. It takes maybe an hour to do it the first time you do it, but after that, you can repeat it relatively easy each and every year. But here's the thing. The backdoor Roth IRA only lets you contribute, that's say $7,500 per year. What if you want to put more money into a Roth? Well, that is where the mega backdoor Roth comes in. So what is a mega backdoor Roth? Well, the mega backdoor Roth uses your 401k plan or 403b plan instead of an IRA. And it's called mega because the contribution limits are much higher. So for 2026, the 401k contribution limit is $72,000. And if you're age 50 or older, it's $80,000. And a little nuance, if you're between age 60 and 63, it's actually $83,250. Now, most nurses think that the 401k or 403b limit is the $24,500. But that's just the employee deferral limit. The $72,000 limit includes everything: your contributions, your employer match, and something called after-tax contributions. Now, after-tax contributions are the key to mega backdoor Roth. And again, let me walk you through an example. So imagine a CRNA making $200,000 per year. She contributes the $24,500 to her 403B. Again, that's the max employee deferral. Her employer will match her 6%. So that's $12,000. So far, she's actually at $36,500 total, but the limit is $72,000. So she therefore has $35,500 of unused space, if you will. So if her 401k plan or 403b plan allows for after-tax contributions, she can contribute that $35,500 difference. Then she converts those after-tax dollars to either a Roth 401k within the same plan or rolls them to a Roth IRA outside of the plan. Suddenly, she's putting $35,500 into a Roth account every year. And that is in addition to the $7,500 Backdoor Roth IRA that she can still do. So we're talking a total of $43,000 in annual Roth contributions. Again, over 30 years at 7% growth, that is $3.2 million tax-free. So this is hugely powerful, but not everyone can do it. See, the problem with the mega backdoor Roth is that only about 40 to 50% of 401k or 403b plans in the United States allow for the after-tax contributions. So your retirement plan has to have two features. First, it has to allow those after-tax contributions. And these are different from Roth 401k contributions. And then second, it has to allow for either in-plan Roth conversions or in-service distributions. I don't explain those. An in-plan conversion means that you can move the after-tax money to a Roth 401k in the same plan while you are still working, while an in-service distribution means that you can roll the after-tax monies to a Roth IRA outside of the plan, again, while you are still employed. But if your plan does not allow for both of these things, you cannot do a mega backdoor Roth. Now, I've seen large hospital systems that are more likely to offer this, but smaller practices usually do not. So how do you find out if your plan allows for it? Well, email your human resource department and ask them two questions. Does our 401k or 403b plan allow for after-tax contributions? And does our plan also allow for in-plan Roth conversions or in-service distributions? If they say yes to both, you are in business. But if they say no, you cannot use this strategy at your current employer. But of course, you can still do the regular backdoor Roth IRA. All right, but let's say you are part of that 40 to 50% and you can execute a mega backdoor Roth. How do you do it? Well, here's what you do. Step one, you want to max out your regular 401k contributions first. Again, $24,500 for 2026 or $32,500 if you are age 50 or older. Step number two, figure out how much your employer is going to contribute. Typically, that's something like a 3% to 6% match. Then step three, subtract those two numbers from the 72,000 because that number is the after-tax contribution space. Step four, now you want to contribute that amount as after-tax dollars to your 401k. And step five, you then convert those after-tax contributions to a Roth 401k within the plan, or you roll them to a Roth IRA outside of the plan. And you want to do this immediately. This last step is critical because if you let the after-tax contributions sit and grow, well, the earnings are taxable to you when you convert. And so the goal is to convert so quickly that there are $0 in earnings. And I have seen some plans that have automatic conversion, meaning every time you make an after-tax contribution, it automatically converts to Roth for you. That ideally is the best setup. While other plans may only let you do it quarterly or annually, and ultimately that's fine, just don't wait any longer. But here are some of the biggest mistakes that I see about mega backdoor Roth. Mistake number one is making after-tax contributions, but never converting them. Believe me, this happens more than you would think. A nurse sets up the after-tax contributions, but she never completes the conversion step, and those after-tax dollars will grow over time, but the growth is still taxed at ordinary income tax rates when she withdraws the money in retirement. So she loses the whole benefit. You always want to complete the conversion. Mistake number two, confusing after-tax contributions with Roth 401k contributions. This is confusing, but these are different. A Roth 401k contribution is limited to $24,500, and it is part of your employee deferral, while after-tax contributions are separate. They use up that extra space in the $72,000 limit. Mistake number three is not checking if your plan actually allows this. Some nurses assume that their plan allows for after-tax contributions, and they try to set it up, but it's not there. So ask HR first. Then mistake number four, exceeding the $72,000 limit. Now remember, that limit includes everything: your contributions, your employer match, and your after-tax contributions. If you go over that amount, you will have to correct it. And believe me, it creates messy paperwork and potential penalties. So track your total contributions throughout the year. Now, a question I get a lot is, can I do both strategies? And the answer is yes. The Backdoor Roth IRA and the Mega Backdoor Roth are completely independent of one another. You can do both in the same year if you have, of course, the cash flow. So for a CRNA making $250,000 a year with a retirement plan that allows for after-tax contributions, here's what that looks like. You could do regular 401k contribution of $24,500. Say you get an employer match of $12,000. You have mega backdoor after-tax contributions of $35,500. And you still have backdoor Roth IRA contribution of $7,500. So total Roth contributions for the year is $43,000. That is life-changing over a 30-year career. Now, which strategy should you use? Well, for most nurses earning over the income limits to contribute to a Roth IRA, well, you want to start with the backdoor Roth IRA. It's much simpler, it's available to almost everyone, and it's repeatable every single year. As long as you handle that pro-rata rule correctly, it is very straightforward. If you are a high earner with access to a mega backdoor Roth, absolutely use it. But make sure that you can afford to save that much. The mega backdoor Roth works best when you're already maxing out your 401k, your health savings account, and your backdoor Roth IRA. And on top of that, you still have cash left over. So if you're choosing between paying off, obviously, student loans or doing a mega backdoor Roth, you want to pay off the loans first. Or if you're choosing between building an emergency fund or doing a mega backdoor Roth, build the emergency fund first. The Mega Backdoor Roth is for nurses who are already financially solid and want to maximize tax-free savings. I want to change gears real quick and talk about self-employed CRNAs. So if you're a locum tenens CRNA or you have 1099 income, you actually may have more control. You can set up what's called a solo 401k. And with a solo 401k, you are the one who can control the plan features. So you can allow to build in after-tax contributions. You can enable in-plan Roth conversions. Said another way, this gives you the full access to the Mega Backdoor Roth strategy. So for self-employed CRNAs, the individual 401k or solo 401k is one of the best tools available. I want to give you a real world example, another hypothetical that I want to walk through of a couple. Let's say it's a CRNA couple and they're both 42 years old. They have combined income of $380,000. And let's say that they work at a large hospital system that allows for after-tax contributions. Here's what they could do every year. Each spouse contributes $24,500 to their 403b. That's $49,000. Each one gets a 5% employer match on that $190,000 salary. Well, that's $9,500 each, or another $19,000 combined. So backing into it, each has $38,000 of remaining space for after-tax contributions. That's $76,000 combined. They convert those after-tax contributions to Roth 401ks immediately. And they also each do a Backdoor Roth IRA. So $7,500 each for $15,000 combined. So total annual Roth contributions, $91,000. If they do this for the next 23 years until they retire at, say, age 65, again, let's use 7% growth, they'll have about $4.5 million in Roth accounts, all of which is tax-free. Now, compare this to a couple who only maxes out their 403bs and has everything in pre-tax accounts. They'll have more total savings overall, but keep in mind, they will owe taxes on every dollar that they withdraw. At a 24% tax rate in retirement, that's over $1 million in taxes. So in theory, the Roth strategy saves them $1 million or more. I also want to talk about tax reporting. When you do a Backdoor Roth IRA, you will receive two tax forms. Form 5498 shows your traditional IRA contribution, and Form 1099-R shows your Roth conversion. And remember, you have to file IRS Form 8606 with your tax return because this tracks your non-deductible basis. And a lot of CPAs and tax preparers miss this. So make sure that yours knows that you did a Backdoor Roth conversion. If Form 8606 isn't filed correctly, you could end up paying taxes twice on the same money. And for the Mega Backdoor Roth, your 401k provider will send you a Form 1099-R if you do an in-service rollover to a Roth IRA. If you do an in-plan conversion, it stays within the confines of your 401k or 403b. So there's usually less paperwork. But either way, you obviously want to keep records of what you contributed and when you converted. Now, what if your plan doesn't allow for a Mega Backdoor Roth? Well, if your 401k or 403b doesn't allow for after-tax contributions, you still have a few options. First, it's worth a shot to ask your HR department if they'd consider adding it, especially if you work at a large hospital. Sometimes employers don't even realize that employees want this feature. And then second, more importantly, you want to focus on the strategies that you can control. Max out your 401k or 403b every year. Do the Backdoor Roth IRA every year. Max out your health savings account if you have a high deductible health plan. Save into a taxable brokerage account. Use tax loss harvesting to minimize taxes. And third, if you have side income, consider setting up that solo 401k for that bucket of income. Even if you only make $20,000 from locum work, you can funnel some of that into a Roth through a mega backdoor strategy. And here are some other considerations. If you're a travel nurse with variable income, the backdoor Roth IRA makes sense when your income is high. You want to do it in years where you cross that income threshold I started with. And if you're a per diem nurse without employer benefits, you want to focus on the backdoor Roth IRA and have an individual 401k or solo 401k if you have 1099 income. And lastly, if you're nearing retirement, know that these strategies still matter to you. A 55-year-old CRNA doing a backdoor Roth IRA, even for 10 years, can still accumulate $100,000 or more tax-free. All right, let me wrap this up. The backdoor Roth IRA is a strategy for every high-earning nurse and one that you should use. It's simple, it's legal, it works. As long as you handle the Pro-Rata rule correctly, you can do it every year for the rest of your career. Now, the mega backdoor Roth is more advanced, and it, of course, requires the right 401k or 403b plan, and it requires significant cash flow. But for CRNAs or NPs who can use it, it's one of the most powerful wealth-building tools available. So whether you do one strategy or both, you are building tax-free retirement savings that compounds on top of itself over decades. And so therefore, when you retire, you will have accounts that you can draw from without worrying about taxes. Again, no required minimum distributions, no IRMA surcharges on Medicare, all just tax-free money. Again, start with the backdoor Roth IRA this year, and then check if your employer allows the mega backdoor. And if you want help putting together a strategy for your specific situation, feel free to reach out. You can schedule a complimentary discovery meeting through the link in the show notes. Thanks for listening to this episode of Money RX for CRNAs and nurse practitioners. Again, I'm Brett Fellows, and until next time, take care of yourself and take care of your money.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.